Right. This is question 152, hurling. Let's look at the big points here. So they again, good revision for you because again, but your work is actually very good. So you seem to know, and I'll take you to the answers so you can see where you're going. Um, they distribute work via their own website. This was upgraded, so you're thinking you might be able to smell risk here. Whenever we talk about systems, the risks are error and completeness, because during the transfer process, work might be lost. So in general, any upgrade, any transfer. So I guess the solution is running parallel systems, if you like, and looking very closely at the transfer journals and the transfer procedures and testing the controls over that and looking for exceptions. So that's that, by the way. And additionally, they entered into this transaction to buy this thing. So it says they enter into transaction. It doesn't quite tell us what's going on. So you're thinking, what's going on here? Do you have it? If you don't have it, well, we don't want to see it on the non-current asset register. And we want all the documentation to see whether or not, because we don't know. It's really about recognition, really, isn't it? um, So we then read this business here about 5 million. Again, I know you're not doing financial reporting, but you might have, I imagine, I hope, come across or remember there's a difference between irredeemable and redeemable preference shares. If you don't, it's okay. The real argument here is the 5 million of irredeemable shares that are irredeemable, if you like, as you can imagine, from the term, are not payable, repayable in terms of actual capital repayment. So they're almost the equivalent of capital, if you like, and so hence should be recognized within equity in terms of classification. So we don't want to be, so basically what we're saying we don't want to understate equity, or if you like, overstate non-current liabilities. That's the issue there. It's classification really, and disclosures, of course. Typically, something like this will have some sort of attachment. So we want to see what assets, if you like, are secured against this loan. We want to see clear disclosures of that. So I guess request for the bank letter will reveal that. This question again of UEL, we come across over and over again, and I think you might have heard me highlighting. The fact is, as soon as you increase the UEL of something, you reduce depreciation charge, and you in effect overstate assets. So if you want to overstate your assets, increase your UEL. Our best test is to really look for. Of course, there's the whole discussion with management as to the rationale and the thinking behind it. But also, we also want to be observing and looking for other assets that are actually being sold. And as long as those assets, if you're selling other assets within 2 years, you're selling them, then this is flawed. You know, we want to see evidence that it is actually you are actually using these assets for 3 to 4 years, not just saying this. Um, Again, this is, if you like, then of course we have the natural issues of trade receivables. The good thing about this audit topic with typically is because we know the focus being the statement of financial position. There's only so many balances you can go to. So we have trade receivables being affected here again. This signifies sends a signal straight away about, okay, you're trying to increase your sales targets. We know, therefore, you're trying to will likely manipulate revenue in whatever format, whether we use analytical procedures to compare GP ratio from 1 month to the next, or just look at sales, really see significant increase in sales from 1 month to the next. We know straight away there's an issue, so we're thinking cutoff. We're thinking whatever tools you would try and use to manipulate an increase in revenue. So whether you try and put in sales from the previous period into our period, whether you're not refusing to recognize certain provisions for doubtful debts or bad debts, we're alert. Again, we can see here evidence credit terms. So we're looking at best evidence, of course, is to carry out an extended post year end cash receipt test to see whether the money's coming in. Right. So again, it says you can see here results. So I'm suspicious. It's gone 5%. I'm suspicious. This so much, and I think they want 8. They want 8. So this you can still go a bit more. Launch some new products. Mixed. So we now have products sitting in our inventory that are potentially obsolete or won't do very well. So we should be thinking write off inventory IS2. Highlight that. Mention that if you know it. And that's valuation. So valuation again post year end sale. Just look at the trend. Legal action. lawyers contacting recognition of provision for this because they're not happy. Yes, these Penta-Q people. Um, and he's pressuring you. So it's not a problem per se, someone wanting to get their audit done early. It just means either we come in, do a bit of an interim audit, bring on more staff, as long as they're aware of the cost. And if they can't, but again, professional skepticism, what's the push for? Risk of errors, right? So that's that. And of course, I think there's a safeguarding issue here. Sorry, not safeguarding. Yeah, safeguards actually, threats and safeguards, and I think there's a separate question on this. Yeah, safeguards, and we'll talk about that. So a number of things here they wish you to advocate, to act on their behalf and help them, and then they also talk about taxation services, which in of itself is not a problem. It's just this 50%. That's a nice number over 2 years. We want to bring that in. So very clear, specific knowledge. Here we are. This is still outstanding. The books technically say you shouldn't do any more work, but hopefully you'll see the answers tell you to be a bit more practical and maybe set up some sort of scheme to raise money. But again, the question is being coming up with some good, relatively good, clear answers. Let's look at your work. Right. So again, you good. So this is the first time they're asking about audit risk. This is a popular question. AR, yes, inappropriate opinion. Good, very good, good, very good. You highlight those two areas. Inherent risk. Yes, good representation, and has nothing, assuming there were in there were no assuming there were no internal controls, complex accounting treatment. Okay, great. So we're really saying that irrelevant of the internal controls, um, the nature, it's more to do with the nature of the transactions, almost like external to the business. Just the nature of our business exposes us, if you like, or the nature of the industry, if you like. So there's almost nothing we can do about it. So everything that can cause the risk of material misstatement before controls are considered. So we're going, and here good, prevent, good, or detect, smashing, brilliant. Good. And then it just means that our procedures have not been able to pick up. And you could expand that, sampling, non-sampling risk, but good work. I'll put figures on it at the end. So you talk about the website upgrade, very good. Yes, I don't even think I noticed the cost figure. Oh yes, there is a 1.1 million, exactly. Capitalization, good. Yes, the website upgrade. Transfer. I was thinking more errors, in fact, with this website upgrade, but that's it. Of course, there's the capitalization, of course, of that, and to ensure that. So you're reviewing the cost. Some of it might be maintenance, as you've said. Good. Legal process. Yes, exactly. Correct. Very good. Overstatement of PPE. Good. Determine whether legal ownership. Yes, that's right. And so we're looking at the rights and the obligations. Determine. Ask for the title deeds. To see if you have them. They're now yours. Good. Great. All right. Sorry. Yes, we're on to the next page. The increase will reduce. Good. Yes. That's. Oops. Sorry. Then that will do that. Yes, that will reduce the depreciation charge compared. This may cause exactly. Yes, should be discussed with management. Um, Credit terms. Yes, discussed with management. Debt expected to recover. Yes, again. Yes, that's good. Legal action, very good. Kind of what we were saying. Very good. Very good. So I'm quite, yeah, I'm very quite. I think you're good. You're working well. Recall the huge problem. Mean the inventory is overvalued. Yes, that's right. Good. Yes, detection risks. Professional skepticism. Good. Reviewed timetable. Perfect. Interim audit. Really good. 5 million preference shares recognizes equity. Very good. In non-current viability, this is good. Overstating, smashing. And finally, let's look at your last page. Great. So this is the safeguard. Safeguard. So this is a good work here. Very clear. Very good. Very clear. And here we have this question of the ethical and the safeguards. So we have very good advocacy. Oops, let me get my pen out. A number of threats here. Advocacy, self-interest, overdue fees. Again, Yes, that's true. Loan, that's very true. Self-review tax services. So either you're using very different teams to ensure that you're not at risk. Yes, good. Material. And then, of course, there's the nice kind of 15% over 2 years you can mention here as well. You were the person last year. I think you perfect. You good a 2 year grace period. You can't be doing that. You need a 2 year period to separate yourself, and fees should be based on the. So some very good work. Very good and comfortable material, right? So just kind of very. I'm only just taking to the answers just because, but your work is very quite. You're on it, very much on the right track. So again, I think again, and you're adding that value. I think what you can just do to make your work even better is this just highlighting things like um, this thing here about this assertion about a class of transaction, which is an income statement issue, account balance, which is a statement of financial position, or disclosure. So the key point is these are the three things we're really looking at, aren't they? The income statement, the occurrence, account balances, existence, stroke valuation, and completeness, of course. Well, completeness in both parts, and disclosures. Completeness for everything, really, ultimately. Cool. And then let's quickly move on into here. We see this, everything you've really talked about. I mean, and there's nothing really for me to highlight. You've kind of talked about everything. I think maybe the only one we talked about useful life, the customer, the sales. I don't think we didn't mention that, but I think you only needed 8 sales. So that's an issue there. This factor that we're like to see manipulation of sales, of revenue, and let's see, what else? Yeah, sales returns. Yes, so we talked about the the product sitting in inventory, potentially needing to a write down. Um, I think yes. I think we've. I'm trying to think if there's anything else. I think we've covered most of the things. Yes, in the pressure, revised timetables. Um, I didn't notice this final dividend discussion, but there's a lot there for us to work with. Great stuff. Next question. We'll go on to that.